What if we told you there's an invisible network that decides where your savings go, what your retirement looks like, how much your government can borrow, and even the price of your morning coffee? It's not a conspiracy, it's financial markets. And whether you invest or not, your life is already tied to them. Welcome to Unravel, Money and Economics. In this channel, we simplify the world of finance, economics, and money, so you can understand how it all works no matter your background. Today, we're diving into the world of financial markets, what they are, how they work, and why they matter for everyone. Let's get started. So, what are financial markets? At their core, financial markets are places, physical or digital, where people and institutions trade financial assets. Things like stocks, bonds, currencies, and commodities. In other words, they're where money meets opportunity. But financial markets aren't just for Wall Street or hedge funds. They impact everyday life, from your mortgage rate to your pension, from inflation to job security. To understand them, we need to explore the main types of markets, what each one does, and how they interact with the broader economy. Let's start with the most well-known, the stock market. When people talk about the market, they often mean the stock market. Stocks, also called shares or equities, represent ownership in a company. If you buy a share of Apple or Tesla, you own a piece of that company. Why would companies sell off pieces of themselves? To raise money. Instead of borrowing from a bank, they issue stock to fund new products, expansion, or operations. And why would you buy it? Because if the company grows, its stock price can rise, and you might earn returns in the form of dividends or capital gains. Stock markets like the New York Stock Exchange or NASDAQ bring buyers and sellers together. Prices move based on supply and demand, expectations, news, earnings reports, interest rates, even rumors. But stock markets also reflect economic optimism or fear. A rising market or bull market often signals confidence. A falling market, a bear market, can indicate worry or even recession. And beyond the headlines, millions of individuals and pension funds rely on the stock market to grow their savings. But stocks are only one piece of the puzzle. Let's talk about something more predictable: bonds. Bonds are loans, not ownership. When a government or corporation needs to borrow money, it can issue a bond. Investors buy the bond, effectively lending money to the issuer in exchange for interest payments over time. At maturity, the bond is paid back in full. So while stocks can be volatile and risky, bonds are generally seen as safer, steadier investments. Governments use bonds to finance infrastructure, social programs, or even wars. Corporations use them to grow or refinance debt. There's a whole global market for bonds, from U.S. Treasury bonds to corporate bonds, municipal bonds, and more. Bond prices move inversely to interest rates. When interest rates rise, bond prices fall, because new bonds offer better returns than older ones. This interaction between bonds and interest rates also affects mortgage rates, car loans, and business borrowing. In fact, central banks like the Federal Reserve often buy or sell bonds to manage the economy, a core tool of monetary policy. So stocks are about growth, bonds are about stability. But what about the things we actually use? Let's talk about commodities. Commodities are raw materials: oil, gold, wheat, coffee, copper. They're traded in global markets like the Chicago Mercantile Exchange or London Metal Exchange. Some people buy commodities to actually receive the goods, but most of the market is driven by speculation and hedging. Airlines hedge fuel costs. Farmers hedge crop prices. Investors speculate on future prices. And because commodities are global necessities, their prices are incredibly sensitive to geopolitics, weather, conflict, and demand shifts. A drought in Brazil can spike coffee prices. A war in the Middle East can send oil soaring. A bumper wheat harvest can bring down food prices. Commodities markets directly affect inflation and the cost of living. And they're also used as hedges. When inflation rises or currencies weaken, investors often turn to gold or oil as safer bets. Stocks, bonds, and commodities are the big three. But they don't operate in isolation. Let's look at how they're all interconnected. Financial markets are interdependent. A shock in one market can ripple across the others. For example, when interest rates rise, bond prices fall, stock valuations can drop. The dollar strengthens, commodity prices may sink. During a financial crisis, like in 2008, everything can fall together. But in calmer times, these markets balance each other out. Investors diversify across stocks, bonds, and commodities to manage risk, and central banks monitor them all to guide policy decisions. These markets also reflect global trends. The rise of emerging markets, the impact of AI, the shift to green energy. Financial markets aren't just charts and numbers. They're stories about confidence, fear, progress, and change. Let's break down how they affect your life, whether you invest or not. Even if you never buy a stock, bond, or commodity, financial markets shape your world. Here's how. Job security. Companies raise money in markets to expand, hire, or downsize. Retirement. Pension funds and retirement accounts invest heavily in financial markets. Inflation. Commodity prices affect what you pay for food, gas, and utilities, government spending. Nations borrow in bond markets to fund services. Interest rates. Central banks influence financial markets, which in turn impact your loans. In short, markets are the engine room of capitalism, and understanding how they work helps you make better decisions, whether it's saving, investing, or just staying informed. But let's step back. Why do financial markets even exist? Financial markets serve three core functions. Capital allocation. They direct money to its most productive use, funding businesses, ideas, and infrastructure. Price discovery. They determine fair prices for assets based on supply and demand. Liquidity. They allow investors to quickly buy or sell, making the system flexible and dynamic. Markets also signal the health of the economy. When stock prices rise, it may suggest optimism. When bond yields spike, it may reflect inflation concerns. In theory, markets are efficient. In practice, they're influenced by emotion, psychology, and momentum. That's why markets can overshoot, creating bubbles like the dot-com crash, or panic sell-offs like in 2008 or 2020. That brings us to a key point. Markets are powerful, but they're not perfect. Financial markets can misbehave. Speculative bubbles inflate when investors ignore risks in pursuit of quick profits. Crashes happen when confidence collapses, sometimes triggered by fraud, panic, or economic shock. Over-leveraging, borrowing to invest, can amplify both gains and losses. History offers plenty of lessons. The 1929 crash, the dot-com bubble, the subprime mortgage crisis. In each case, markets reflected deeper economic problems and human behavior at scale. Governments and regulators now monitor markets closely. But the speed and complexity of modern finance means risks are always evolving. So how do you protect yourself? You don't have to become a trader, but you can learn the basics. Understand diversification. Don't put all your eggs in one basket. Learn about risk tolerance. What kind of swings can you emotionally and financially handle? Stay informed on interest rates, inflation, and global events. They all move markets. Be cautious with short-term trends and hype. Smart investing usually means thinking long-term. And if you're not sure where to start, talk to a trusted financial advisor. Financial markets are tools, and like any tool, they work best when used with knowledge. So here's the takeaway. Financial markets may seem distant or complex, but they're woven into the fabric of your life. They fund innovation. They power economies. They shape your savings, your job, and your future. And the more you understand them, the less mysterious and more empowering they become. Got a question or topic you'd like unraveled next? Leave a comment below, and don't forget to subscribe. As we continue to explore the world of money and economics, one concept at a time.